RIIGS in San Francisco. This is Bloomberg Technology. Coming up in the next hour, a roadshow speed bump. WeWork postpones its sales pitch to potential investors, but will the delay help allay investor doubts ahead of its IPO? Plus, defiant Apple. The tech giant tells a European Union court it's been unfairly labeled a tax dodger. More on the case that started Tuesday. And who is laughing now? Netflix co-founder Mark Randolph says Blockbuster laughed at the company's original movie rentals by mail service. We'll hear his thoughts on streaming wars and tech culture. But first, to our top story. It finally happened. WeWork is pushing back its IPO. What was once one of the most highly anticipated public debuts of 2019 is now postponed until October. The shared office-based provider is looking for more time to calm investor doubts about its dropping valuation, governance problems, and financials. Remember that at one point this was supposed to be a $47 billion company. Now that number is about $15 billion and perhaps even smaller. Joining me to discuss in New York, Phil Haslett, the co-founder and chief revenue officer at EquityZen. EquityZen is a secondary marketplace for pre-IPO shares. And also in New York, Bloomberg's Crystal C, who has been covering this troubled IPO. So Crystal, let me start with you. What was the problem today? Is it valuation, financials, or governance problems?
Taylor, is all of the above. The simple answer to this question is they have a lot of things to address before they can go out to the investors again and ask them for their money. Like you said, they were looking for a $47 billion valuation, and now we're hearing it could be as low as 12 to 15. And they have actually made a lot of changes to corporate governance, but investors are really looking at valuations, whether they will improve their performance, financials, and whether more changes are needed to corporate governance structure in order for them to be convinced about the valuation that they want to get.
Phil, this morning on The Open, they spoke with Gene Munster, who co-founded Loop Ventures. He had some comments, particularly as it related to the valuation part of WeWork. Take a listen.
That valuation, I think, is really a wake-up call to private investors that the public markets are holding them accountable. And the specific reason I think this report reflected that is the amount of cash burn. What is a consistent theme in your setup here address this is that companies that are losing a lot of money, not surprising, are being held to lower valuations. In the case of WeWork, it's $1.5 billion over the last year, which is more than what Tesla lost. To put that in perspective.
Phil, react to those comments on valuation.
Totally. So, I would say WeWork is kind of in a space of its own, having lost $2 billion in 2018. I think in a mix of Lyft, Uber, and WeWork planning to come public in 2019, I think we've seen really like the largest losing companies coming out of kind of the pre-IPO tech space. At EquityZen, amongst these types of groups of companies, we also see plenty of companies that are burning only $100 million or $200 million in cash. I think WeWork is certainly an exception to the norm, but gosh, writing off $37 billion of value over a period of 3 or 4 weeks is certainly going to catch the attention of a lot of venture capital investors and also public market investors.
Phil, we can joke on Twitter all day long about how you value a company using the discounted cash flow model for a company that does not have cash flows. But on a very serious note, how do you value this company?
Sure. So with WeWork, the first thing we looked at was trying to look at a multiple of revenue and some of the competitors that are publicly traded. And the first thing that we found at EquityZen, through our research, was that some of their competitors like IWG were trading at, I think, 1 or 1.5 times their revenue. WeWork earned, I think, about $2 billion of revenue in 2018. So to come out at a $47 billion valuation seemed ludicrous on its own front. I think the toughest thing for WeWork is trying to explain and defend itself as a technology company, where in reality it really is a real estate company that happens to have some technology bells and whistles. And so I think this really is a big wake-up call for them to maybe recalibrate those expectations, maybe in Q4 or even a little bit later in 2020.
Crystal, bondholders also had a recalibration of expectations today. I want to show a chart on the Bloomberg terminal for our audience, which shows the price of those WeWork bonds that are now falling a record amount this morning, more than 6 cents on the dollar, gone as low as 95, now hovering around 97 cents on the dollar or so. How nervous do bondholders continue to be?
some of this credit facilities is contingent to how well the IPO perform or whether the IPO happen at all. So WeWork put out this statement this morning saying that they are committed to completing this IPO within the end of this year. So that should give bondholders a little bit of a confident boost, but the valuation continues to be the biggest concern because some of that value of the bonds are tied to how well they perform. If it becomes a 15 billion company instead of a 47 billion company, then bondholders are going to get nervous.
Phil, talk to me more about that valuation. What did the private market see that the public markets are missing?
Sure. So one of the interesting things we saw at EquityZen, where we see a lot of kind of pre-IPO secondary flow before companies go public, is that there actually wasn't that much interest for WeWork, particularly at the valuations that it had attained from SoftBank and from other investors in primary capital raises. You know, we saw much healthier markets for companies that went public recently in 2018 and 19, companies like DocuSign, companies like Slack that were a little bit more popular with investors, and we kind of would have expected to see something similar for a company like WeWork because the brand is so ubiquitous. However, there was a little bit of hesitation from some of those investors of that lofty valuation. You know, when you get north of $20 billion in valuation, you know, you're not talking about hundreds of unicorns there anymore. The number of decacorns or whatever unit you want to call really drops precipitously, and particularly when you have that kind of valuation coupled with losses of, you know, north of $2 billion, I think was just kind of a recipe for disaster here. And one thing I think about is that we've been in very much a bull market, not only in public stocks, but also in private companies. And that has led to founder-friendly terms on how they've raised capital. And at some point, you are going to have the pendulum swing. And I think when you have this type of headline cut in valuation will really start to shift those types of numbers over to investors that are going to start to ask for more corporate governance, more reasonable valuations, and other parts within the cap structure that they'll get more comfortable with.
Crystal, when we were talking about bondholders, you mentioned that a $6 billion financing was contingent upon raising $3 billion in that IPO. Assuming that doesn't happen, when does WeWork need to get more cash and where do they get it?
I think the very simple answer to that question is they always need to get more cash as soon as possible. If the IPO doesn't happen by the end of the year, you know, they may look into tapping to SoftBank to get a bit more funding. And there were actually some talks about SoftBank being willing to put in another couple $100 million into the company, but that would not move the needle. They would definitely want to do an IPO to, you know, recapitalize.
Phil, quickly here, any ideas on when is their drop-dead deadline for raising more cash?
Gosh, I got to think that they might want to push this over to 2020, but with only about $3 or $3.5 billion of cash available to them, things could get really, really messy here starting in Q1 of 2020, particularly if a lot of the lenders that have promised to provide them capital if they raise their IPO before 2019, they're going to kind of put them in this tight bind. If I were them, I'd spend the next quarter really tightening the belt and trying to overhaul spending, show some great numbers at the end of Q4, try to renegotiate with some of the banks and try to list in Q1.
Phil Haslett of EquityZen and Bloomberg's Crystal C, thank you both for joining me. Bloomberg Technology. I'm Taylor Riggs in San Francisco. Back to our top story of the day. WeWork has signaled it is putting off its troubled IPO. The office rental startup says it now expects to complete the share listing by the end of the year. In January, SoftBank invested in the company at about a valuation of $47 billion. Now it's expected that WeWork would be valued at less than a third of that. So is this an issue of timing or valuation? To discuss, I'm joined by Lightspeed partner Nicole Quinn. Nicole, I want to ask you just real quickly, because that is the story of the day. Are you surprised at all around the volatility of WeWork?
So with regards to WeWork, it's certainly been an interesting one. If you think about it, in the first half of this year, they had $1.5 billion of revenue. They also had $1.4 billion of losses. And so there was probably a day where the market was okay with that. But the market right now is not comfortable with that. You've seen that with Uber. You've seen with Lyft. The market's not comfortable with those losses. I'm right now an early stage investor at Lightspeed. My prior career, I spent nearly a decade at Morgan Stanley, taking a lot of these companies public, like Facebook, Groupon, Pandora. And so with all of these companies, we'd say we really need to see a line of sight in the next 12 to 24 months of profitability. And that's, I think, what's lacking here.
Well, and Nicole, within your decades of experience bringing a lot of these companies to the public markets, is the public markets more than ever being more discerning about the companies where the math works and the companies where, frankly, like you said, the bottom line doesn't match?
So I think that's exactly the right question to be asking, because the markets right now are still very much open for business. At Lightspeed, we've had Snapchat, Nutanix, MuleSoft, Zscaler. A lot of our companies do very well straight after IPO. And those are good, solid, consistent businesses. But you're right, the market is very much thinking about, well, are these companies going to be profitable? And that's actually where you're seeing a real distinct difference in the market.
Do you think the markets feel overvalued? Are they too lofty?
No, I don't think that's what we're seeing right now. So if you actually add up all of the technology unicorns in total, they actually only add up to 5% of the S&P. So there's still a huge amount of growth to be seen, but also valuations. I think people like to often say that the private market valuations are too toppy, but when there's a good, solid, consistent business that is focused on the bottom line as well as consistently growing the top line and having a true line of sight there, then the market is willing to pay a good valuation for that and will often trade up pretty significantly. You saw the bounce in companies like Zoom, and so I think we're going to continue to see more of that.
Nicole, I had an interesting conversation with John Chambers, formerly of Cisco, last week, and he said that these private companies need to be coming to public markets much sooner, that they're staying private too long. How do you feel?
So I think you're not going to see a big change with that for a while. In fact, there's more and more later stage companies being built. At Lightspeed, we have 9 billion assets under management. We have our early stage fund, but we also have our growth stage fund. And the reason for that is because we see companies waiting longer and longer to go public and preferring to stay private. And so it makes sense for us to also adapt our business model to have a growth vehicle, to be there to support those companies while they want to stay private. And then when they get to a point in their business model where they are stable, then it's a great time for them to go public. But there's no point in them going public when the market's going to see it as too volatile. So it's good for them to have that option.
Nicole, you are an investor in some pretty strong female-run, female-founded businesses. Zola, Daily Harvest are a few examples. What does your research tell you about female-run businesses and why they're successful?
Yeah, you're right. Over 1/3 of our consumer portfolios at Lightspeed have female founders. It's actually 70% of my portfolio. And so it's a big focus for us. The reason being, if you're starting a consumer company, the end consumer is usually a woman, given the fact that women make up 80% of household decisions. And so we're seeing more and more women finding problems that they've experienced themselves and then bringing a really, truly unique solution to the table. Zola is a great one that you called out. Goop is yet another one with Gwyneth Paltrow. We yesterday launched Lady Gaga's House Beauty, and beauty is something that she has been so focused on for many years. And so it's great because they're experiencing the pain personally and then going on to build these significant businesses around that.
This is a crowded space, though. You have people like Kylie Jenner partnering up with Ulta Beauty. Lady Gaga, as you mentioned, an exclusive partnership with Amazon. How do you stand out in this crowded field?
So we actually spent a year surveying the whole beauty market. It's an interesting category because it's high margins, high repeat rate, high customer love. But we found that most of the companies were about fitting in. Lady Gaga's, for example, was really about standing out. And so to answer your question, one of the ways we think about this is true innovation, true experimentation and finding unique products. And so with some of the products we launched yesterday, you'll see there is one product called Glam Attack. It has never been done before, this product in beauty. And so it's super interesting. And we're already seeing the influencers absolutely go crazy today for these products. And so I think that's it, innovation and unique products.
Wonderful. Nicole Quinn of Lightspeed, thank you for joining me.